AM Best has published a new ratings criteria evaluating mortgage insurance. Joining us now to discuss the criteria is Emmanuel Modu, Managing Director and Head of Global Insurance-Linked Securities for AM Best. Manny, what insurance segments does the criteria cover?
The criteria covers two segments. The first segment is private mortgage insurers, or PMIs. And there are 6 PMIs in the U.S., and collectively they cover about $200 billion of risk in force as of 2016. The second segment are reinsurers that cover mortgage risk. I should point out that this criteria is part of our bigger insurance rating methodology called Best Credit Rating Methodology, or BCRM.
Why did AM Best feel a need to publish the new criteria?
Insurance risk, mortgage risk has been eking its way into the insurance industry for quite some time now. Over the past 5 years, there's been a big increase in that infusion of risk. So AM Best felt the need to address this risk in its criteria. For example, between 2013 and 2017, Fannie Mae and Freddie Mac have ceded about $14 billion worth of risk through their insurance credit risk transfer programs to the reinsurance industry. In 2017 alone, that risk cession was about $5 billion. But in 2013, it was only $200 million. So you can see the risk is increasing into the industry. And we believe that risk will keep making its way into the industry for some time now. PMIs have also been ceding risk to the reinsurance industry as well. In 2016, PMIs ceded about over $500 million worth of premiums to non-affiliated reinsurers. So that's why we need to address the issue of risk, mortgage risk in the industry.
Will there be any companies facing ratings actions as a result of the new criteria?
No companies will face rating actions as a result of the new criteria, but there will be increased net required capital for each company involved in mortgage risk. The companies that will be facing the highest increase in NRC, or net required capital, are companies that run a high investment risk portfolio, and companies that have low non-mortgage reserve risk. And the reason is quite simple. It's because mortgage loss reserves are highly correlated with investment risk, although they're lowly correlated with non-mortgage loss reserve risks.
So will AM Best be looking for additional information from companies as a result of the new criteria?
Yes, we will. For PMIs, AM Best will need to have loan level data because we're going to run the entire mortgage portfolio through our credit risk model. For reinsurers, we need to know exactly which Fannie Mae and Freddie Mac transactions they cover, and also whether they have other reinsurance transactions with the PMIs we need to be concerned about. With this information, we can actually calculate new net required capital based on our calculation of loss reserve risks.
Manny, thank you for speaking with us today.
Okay, thank you.
To view the new criteria, visit ambest.com. For AM Best TV, I'm Meg Green.